Right. I hope everybody's doing well. It is Memorial Weekend upcoming. This is Friday, May 28th of 2021, and we are going into Memorial Weekend, and there's a lot of Bitcoin action going on, a lot of discussion around Bitcoin and what it's going to do over the weekend. We've had a little bit of a drop here lately, and everybody wants to know, where is Bitcoin heading? What is the price? What are we looking for? And a lot of the talk out there right now is on the Wyckoff distribution model, and you can Google that, and there's a lot of recent charts out showing the Bitcoin market compared to the Wyckoff distribution model, and that trading technique executed by institutional traders. Now, I'm not a technician, I'm not an analyst, I don't draw charts, I'm an investor. So what I do is I take the analysis of the best in the business out there, and I look at it on a macro scale, and I look at the charts and patterns, and I draw my own conclusions about entries, exits, things of that nature. And what's interesting about the Wyckoff distribution chart is the big question is, where does it start and where does it end, and where are we in that cycle? So what we're looking at right now is basically the chart of Bitcoin from October. Let's go back a little bit. And around this September, which was the low, September of 2020, before the bull run of 2021, ultimately where we peaked out at that 64,000 level before we just dropped off recently. So the real question is, in the Wyckoff distribution model, there's an accumulation phase everybody's aware of that happens before the run up, and then you get to the top where where the distribution takes place, and then you have the markdown towards, going back down towards the bottom, where you're going to level off again back into the accumulation phase, and you do it all over again. So if you go back and you look through the charts of Bitcoin over the years, this is that March of 2020 drop that we had. So that's the pandemic drop. And you got to kind of discount that, because one could argue that if we didn't have that, we would have continued up from there along the path of that bull run. And then one could argue that, just like the markets, a lot of the results of what we've seen in this bull run and this parabolic move to the top is because of the liquidity pumped in the market. But it was already trending in that direction before that March, before the pandemic, before March. And you can see right here, we had just come off that July 2020 top, and then we had some very odd movement here. It'd be kind of hard to make the Wyckoff fit there. But institutional traders, institutional talent has been in the market going back to 2016, 2017. There wasn't a whole lot of attention paid to it in the early days, 2013, 2014. It wasn't really taken very serious then. But when we got this 16, 17 movement up to the top in December of 2017, that got a lot of attention. So you're talking about a move from basically, that year, where it went from pretty much, $500, $600, $700, $800, and ran all the way up to $20,000. That got a lot of people's attention, and it got a lot of attention on the way. And that's when it started attracting the attention of the institutional traders, the professionals, the pros, the people that do this all day, every day for a living, the people that I rely on for my information. Again, I'm not even going to begin to try to do the technical analysis that these people have been doing their entire lives. They've gone to school for it. They've worked under mentors. They've been through all kinds of cycles for 10, 15, 20 years. So that's who I study. That's who I follow. That's who I get my information from. And then what I do is I go back and I look at these patterns and what's happened in the past to try to formulate an investment strategy for myself as an investor, both opportunistic and long-term, with different types of assets and different types of markets, depending on what it is. But when it comes to Bitcoin, you see this peak in 2017 of December, and then it, just kind of drops off the cliff there into February. Looks like we hit that low, and it went from that 20,000 range plus or minus down to about a $6,800 range plus or minus. You had a little bit of a bounce back, and then it kind of hovered, bounced back and forth there a little bit in that March, April range. And then it fell off the cliff again a little bit. I mean, it wasn't that big of a deal. It went from 11,000 back down to about 6,500, almost cut in half. Yeah, that little drop there. And then, of course, it bounced back again. And then it started going into that down cycle until December-ish of 2018. So if you are looking at the Wyckoff distribution trade and you're looking at the institutional and technical talent in the market, you could argue that this was a bit of an accumulation phase to execute another Wyckoff type distribution. So accumulating here, you have the markup phase here, you have the distribution on the top, you have the markdown phase, and this takes us into December of 2019. And again, from the bottom of December 2018 to the peak of that cycle, which was June of 2019, and then back down to a bottom in December of 2019. And then we get a big bounce off of that back to, in February of 2020, back to about 10,000, which is about half of where we came from. Well, actually, I'm sorry, we were at 12,000 in December of 2019, it looks like. And then we had bounced down to a low of about 6,500. And then it came back up to 10,400 and then bam, fell off the cliff in March of 2020. That was the pandemic. But again, you could argue that we would have kept on going from that, that phase of the market had we had not had the pandemic into what is now the current bull market. So we had that little drop and we kind of hovered along, and somewhere around, it was moving up from the bottom of the pandemic. Again, just a correction cycle off the pandemic. Nobody knew where anything was going in the markets. And then we hit a little bit of a peak in August, back up to about 12,000. And then boom, we had a little drop, lost a couple thousand. And then it kind of leveled off in that September area around 10,000 plus or minus. And then as you look at this, it was off to the races again to a nice little peak. And that's a heck of a run. If you're looking at September when you're at about 10,000, 10.5 plus or minus, and then from September of 2020 to January of 2021, that's just straight up to 40,000. It basically doubled in a few months, had a little bit of a correction there. And this is what a correction looks like along the way. And then it runs up again. You get the correction, runs up again, and then we're down to where we are now in May of 2021. So this distribution top looks a lot like some of these patterns that we've seen in the past when you kind of zoom in on them. So that's what you want to go look at. You want to go look at the past cycles of Bitcoin, and you can look at other investments, the stock market as well, in bull and bear cycles where we've had big run-ups really fast. And then the question becomes, well, where did the accumulation phase? So if this is a Wyckoff trade, where did the accumulation phase begin and where is it going to end? So that's the question. So if you go back and look at past Wyckoff distributions of previous markets, it looks like they all start around the bottom before the bull run. So that puts you at September-ish of 2020, where we are off to the races. And it's pretty much with this one little correction straight up to almost a top there, a little correction, boom, top again, little correction, boom, top again. So this was the accumulation phase. So if you want to say this is an executed Wyckoff trade, the accumulation phase was here, and maybe even before this September 20 timeframe. There could have been some dollar cost averaging along the way where the professional traders, institutional traders, the big talent, where they were accumulating all along the way, and some retail buyers were accumulating along the way, and then working this thing up and then distributing across the top. And then now that brings us to where we are today. And currently we're sitting at 35.8, and it is, I'm on the East Coast, it's 4 o'clock on the 28th on the East Coast. And we've come down and we've been kind of bouncing around in here. So the real question is, where does this go? Does this end up looking like this area here and kind of bounce around a little bit? Maybe we pop up a little bit to that 40, 42 range where there's, a lot of people are saying that's your ceiling. That's where your resistance is going to be, where we're going to get rejected. And then it's going to go back down maybe into the 20s, plus or minus. Well, if that's the case, that takes us real close to the start of the bull run. Again, it probably started around 10 to 15 in September, but you could argue that, it started, somewhere around this area here, December maybe of 2020, end of last year, and then it was up from there. So that puts you at the 20,000 range. So if it's going to complete, if this Wyckoff distribution is not complete and there's still a down leg left, and if you look at that accumulation phase, the markup phase, distribution along the top, then you have that markdown phase. This is right about where you get that complacency denial kind of stage in the psychology of the markets. If you look at those charts, you can Google these Wyckoff distributions in psychology of the markets, and you kind of see as you're coming down, you get these little bounces where it's kind of almost like a little relief rally, and you get kind of that complacency denial phase. And then next thing you know, you have another leg down. And then that's when you find your bottom. We haven't really retested that bottom yet, where we leveled off after the big sell-off. So we have to retest that, establish that, see if we break through, see if it holds, see if it bounces around. And this could go on for a little while. Nobody really knows. I mean, that's the thing. Nobody really knows because it's a unique market. The values are different. The liquidity in the market's different. The level of talent in the market now is different. The awareness of general public, general population is different. There's a lot of people in the markets now that weren't in before that are really watching this. So it'll be really interesting to see where this goes. And one school of thought is it comes through here and, kind of shoots up, you get a little bit of a rejection. And then, if this is the end of the model, and this was the max sell-off that we're going to get, then it's going to kind of accumulate in here, and maybe you could go up. And we don't know where that is going to go to. Some people say 100,000 by the end of the year. Don't know where those numbers come from in terms of justification. But if it gets back to where it was, that's, it's all good, right? So, and then the other school of thought is it bounces around here, gets rejected off that 40-42 level. And then that's when you get that final leg down. And then we find the ultimate bottom. It may bounce a little bit off of that. Then you could run into a little accumulation phase along the bottom for a little while. And then it starts working its way back up. And we don't know how long that is going to take, but we do know it looks like most of the accumulation phases, if you look at where we've been in the cycle. And again, we've got this whole March issue that kind of messed things up because it really all started back here in June, July, March, April, May, June, July of 2020, where the market was, kind of bottomed out after that last run up. And then we were starting to run up from there. And then we had that March correction of 2020. So it could have started back in June, July, August of 2020. And we could have been uphill from there. So from that standpoint, that's 6 months to the peak, I'm sorry, about a year to the peak. If you go back to March, April, May of last year of 2020 to the peak of the market this year, that's almost a year, 8-10 months for a full cycle to take place. And you can go back and look at those cycles, and that kind of seems to play out in pretty much all of the cycles. They seem to be, 12-month cycles. You got 6 on the accumulation to the run up, 6 to 8 months, and then you've got the same thing coming down. So it'll be interesting to see how this plays out, where this ultimately goes, and how long things take to get back to where we came from, and then how long it takes if we're going to search for a bottom and where that bottom is. Does it take us back to that initial run up after the September timeframe where we were at that 20,000 level and then we really started to run up? Is it going to be here at that 30,000 level where we had this little correction here and then we started to run up again? So this isn't really an accumulation phase. This is a markup phase. Accumulation usually takes place before your first parabolic move. But with everything that's happened, the liquidity coming in the market, you could argue that could be an accumulation phase. But again, that doesn't usually happen when you study Wyckoff on the uptrend. It usually happens back here when things are a little bit more level. That's typically your accumulation. And you got to remember, the institutions are long-term players. So for them, a year is nothing. For them to accumulate over a year and plan a trade like this, it's really nothing for them to do. That's kind of what they do. They look to make things happen in the markets with executed trades. It takes a lot of time, a lot of talent, a lot of capital to pull this off. But there's a lot of people that got in at very, very low levels and have accumulated quite a bit. So it'll be interesting to see where this goes. So right now, the two schools of thoughts are, a lot of people are thinking around that 20,000, 15, 20,000 range. It could bounce around here. Maybe you get a test of the 40-42 and it shoots down. Some people think you bounce around here, you get a test of the 40-42 and then it goes up. So nobody knows, only time will tell. But just make sure that you're following the right information when you look at the technical analysis out there. Make sure that these people that you're following know exactly what they're doing. They know what the moving averages are. They know what the different models are, and the different philosophies and scenarios of the technical trades, and that they've been in it for a while. You want to follow people that have been through several market cycles and they know what they're doing. They know what these patterns look like. But at the end of the day, all you can do is decide at what point you're going to get in, at what point you're going to get out, hold, not hold, don't do anything at all. So it's really up to you at the end of the day. Nobody can really tell you what what's right, what's wrong. And at the end of the day, you have to own your decisions in terms of what you decide to do. Investing is serious business, and you don't get any second chances in terms of making up for lost opportunity. So you want to make sure you make the right decisions and you do not get in over your head, over leverage, and bet the farm on gigantic moves, because usually those don't work out too well. But hopefully you can get ahead of the game, make some good bets, and everybody wins at the end of the day. So that's it. I hope you have a great weekend, and I will see you on the next video.